All right, welcome back to this week's episode of the Confident Retirement Podcast brought to you by LPF Advisors. I'm your host here, Kris Flammang. Joining me as always, our co-host and resident CFP, Colin. Hi, Colin.
Yes, sir.
What
Hey,
are
thanks
we
for having me.
getting? Yeah, what are we getting ourselves into today?
Yeah, so we're going to clear up some confusion around diversification, what it is and why it matters, but most importantly, how people should be doing it and doing it correctly, I should say.
Yeah, how you can go about it. What's a good way to think about it?
hmm Yeah,
We're gonna demystify whatever that means.
right. But first, before that, we have our disclaimer. So the information we provide is our opinion and not necessarily that of our firm or the platform. We provide general information only on the podcast and not any customized investment advice. Nothing should be construed as financial, tax, or legal advice here. So you should consult with your own professionals about your own situation. So with that, Kris, let's get into it.
All right, so we hear this word diversification all the time. It's a buzzword out there. It's been around forever. But it isn't just owning like a bunch of different investments, is it? So I suppose what we should do is define what diversification really is, and let's get down to getting into the weeds on this for people.
Yeah, absolutely. So a lot of people think that it's owning all these different investments, but truthfully, diversification isn't about how many things you own, but it's more so on how they react. So, for example, if you own 5 different tech stocks, you're not actually diversified. You're just betting on tech in several different ways, or 5 different ways, I should say.
Yes, right. And that extends even to like maybe a mutual fund or an ETF where you could have 10 or more of those, all with different names. But then when you drill down and kind of look at what they're invested in, you find there's a lot of similarity. We call that overlap,
Yeah.
but you're actually invested or concentrated in a lot of the same stuff. So let's say I do spread my money across different investments. What does that actually do for me? What's the point of that?
Yeah. Yeah. I guess we could rename this podcast Risk Management because that's what it's all about. So I guess imagine you're at a casino and instead of putting all of your money on one number at the roulette table, you spread it across multiple bets. Now, I don't like comparing the casino to investing. It's not gambling when we invest, but the concept still applies. That diversification reduces the impact of one bad outcome. So we like to spread it across the board rather than putting all of our money in one egg, I should say. So let's say you put all of your money into real estate. If the market crashes, you're going to be in trouble. So if you also had stocks, bonds, you might even have some international investments, you're not going to be exposed to just one market swing.
Yeah, and you could even, throw in cash in there, having a savings or a cushion as being a way to diversify of having a asset class that's different than how other things act or interact.
Mm-hmm.
So I get why diversification helps, but is it possible to actually overdo it? Like, can you have too many investments? Can you be too diversified?
Absolutely. Absolutely. So we actually see this a lot inside of qualified retirement plans. So when your employer offers, 15 or 30 different funds, we've seen some people come in and they have a little bit in each of those funds, which is absolutely over diversified. You don't need 100 different investments to be diversified. In fact, owning too many things, especially if they behave similarly, can make your portfolio messy and even harder to manage. So the goal is to find assets that complement each other, not just accumulate a long list of investments.
Yeah, the thing I think about is when I was a kid, you used to be able to go to the gas station. Let's say you put your Coke in your cup, and then they had all those syrups. So you could put like a couple syrups, maybe like cherry and vanilla in there, and that would
Yeah.
taste pretty good. But if you did a squirt of each one of the flavorings, like 15 different ones, and then you tasted it, it just tasted like sugar water, and you didn't get the taste of any of those individual things.
Mm-hmm.
That would be kind of a way of thinking about having too much stuff in there. You're over diversified. All right. So if
You're absolutely
someone's
right.
listening to this or watching this and thinking, well, I have no idea if I'm diversified or not. I have these things in the portfolio. I get the statements. I've got a bunch of names. Where should they start, or how would they know?
Yeah, so it can be overwhelming, but the best place to start is looking at a few key areas. So first, you can start by looking at stocks and bonds. Stocks will give you the growth. Bonds typically will provide you some stability. And having a mix of both will help you balance risk on both sides. Number two is if you wanted to look at different sectors. So we mentioned tech. We also work with people in the healthcare industry. So making sure that we're not too heavily weighted in just one sector. You could even look at energy or consumer goods. Don't put everything in one industry. Then we can look at the geographic spread. So we're kind of dealing with this now, but according to contrary belief, the U.S. isn't the only game in town. International markets can also add some resilience, which we've seen recently. It's not a recommendation. It's just what we're seeing now. Number four is alternative investments. So real estate, private equity, commodities can also add a layer of some diversification.
Yeah, and Colin brings up a good point there. We said it in the beginning, so you should consult your own advisor. We're not giving any specific recommendations on investment categories or sectors or industries. That's going to be personal to you. And the other thing that's worth saying is even though you might be diversified, if you have any of the money that are in risk assets, even though you're diversified, there still always exists that possibility that you can go through periods of time where you're losing value. So a lot of what we're talking about here from a diversification standpoint relates to long-term stuff that you might not need for an extended period of time. Okay, so Colin, what's the bottom line in your mind, biggest mistake people make when it comes to this diversification thing?
Yeah, so very similar to what we just touched on, but thinking that just owning more means owning better. The goal isn't to have a bunch of investments and to load up your account statement. It's to have a portfolio that acts as a buffer when things get volatile. You want things that work together hand in hand. Like you said before, you don't want a bunch of overlap. So we don't want to see all of our investments zigzagging together. We do want to see our investments, do something maybe similar, but even the opposite of what one another is doing. If you're not sure, exactly. So if you're not sure if your portfolio is truly diversified, you can talk to a professional who can help you see the bigger picture. There's also some great software out there that can help you with this.
Okay, so that wraps up our quick discussion today on diversification and demystifying it. It's one of the key strategies for managing risk and also optimizing your long-term returns. It's a discussion we have with every client who's doing investing with us to make sure it lines up with what their goals, their time frame is, what their comfort level is. And true diversification isn't just about owning a mix of stocks and bonds and cash. It's spreading those investments across different asset classes with considerations given to maybe industries and geography, so we can weather various market conditions at various times. And if any of our listeners have more questions about this or other financial topics, you can feel free to reach out at www.lpfadvisors.com. That's our website. Email us using info@lpfadvisors.com. If you found the episode helpful, be sure to subscribe, and you can share it with whoever you want to. You have our permission. Thanks for tuning in today, Confident Retirement Podcast. We'll see you next time. Until then, take care and be well. Thanks, Colin.
Thank you. Appreciate it.
You've been listening to the Confident Retirement Podcast with Kris and Mark from LPF Advisors. For more information on them and retiring confidently, please visit lpfadvisors.com. If your ears are pleased and your mind is now at ease, do share the program with your friends and subscribe wherever podcasts are found.
49 faces looked to him in triumph. Over the last 12 months, they had each taken turns and promoted his business for a week at a time, driving over $987,342 in revenue. What if you had a network of 50 centers of influence who promoted your business every week for a year? Grab your copy of the #1 Amazon best-selling book, The Ultimate Guide to Growing Your Business with a Podcast, at 33% off the Amazon price by going to ultimatepodcastbook.com. Again, that website for 33% off the Amazon price is ultimatepodcastbook.com.